What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is October 25th of 2022. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's Macro Tuesday, I want to spend some time to talk a little bit about what you should know about before you buy the dip. I know a lot of people have been getting excited about Bitcoin, pushing sideways, potentially consolidating here at around $19,000, but I want to go ahead and share three key things that I think are relatively unbiased and real important things you should know about before you go out and buy the dip. And I'm not just talking about Bitcoin, respectively. I'm talking about Ethereum, your favorite altcoins, NFTs, your favorite stocks, even the big technology companies like Apple. We've got a lot of things to dive into today's video. If you happen to like it, drop a like, and let's go ahead and kick things off. Now, later on, we're going to have some more details throughout the video here that are exclusive charts we usually only share here within the Dash Report, our newsletter here on the channel. More on that a little bit later, but if you haven't liked the video, stay tuned until the end. So let's go ahead and kick things off here. I don't want to spend time looking at Bitcoin's price today. I want to dive into some really important charts here. When we talk about the broader cycle about where things are here in the long term, we've got to understand the first major talking point, and that is that we have what's known as innovative cycles in technology. Now, technology is the bread and butter of every sense of progress that we live through as humans. Sure, there are the companies that go out there and, kind of work on the grind to provide the day-to-day services, consumer cyclicals, the things that we use on our day-to-day basis. But what really has pushed the boundaries for the last century for our well-being in life is technology. And this is a really interesting chart that we've showcased to our members on the Dash Report, which is a custom ratio between the NASDAQ and the S&P 500. Now, for those who may not know, the NASDAQ is a broader index of over around 7,000, 9,000 companies in the technology sector, from biotech to technology companies like Apple to small cap innovative startups that have gone public and become billion-dollar companies. But on top of that, the S&P 500 is a broad measurement of the more normal stock market, about 500 of the largest stocks. And that not only has a weight in technology, but also in some of the consumer cyclicals, names like Procter & Gamble and other types of companies that are a little bit more risk off and more predictable. This chart, though, this ratio showcases the performance of how technology, while it does have sharp corrections over time, generally outpaces the overall stock market in the long run. Technology is innovation. And I'm a big believer in the long term that, as we can see in the chart, it moves up and to the right. We want to be long technology in the long run. But it doesn't mean that we can ignore the fact that there are periods of time, multi-year periods of time, where technology underperforms, and entry points in which will leave us holding our bags or positions in the red or practically at neutral for a very, very long period of time. And that's what I want to go ahead and highlight here, which is that as we go through these innovation cycles, while there are periods of great exuberance and excitement, there are also periods of time that are immensely negative for these positions, right? So let's go ahead and take a look where we are right now. From top to bottom here in the NASDAQ to S&P 500 ratio, for nearly 21 months here, since back in January of 2021, we can see that the S&P 500 has started to outperform the NASDAQ, or another way to put it is that the NASDAQ has started to underperform against the S&P 500. We saw this well in advance before the top in equities and crypto back in November of 2021. This trend was already starting to show signals here that the trend was starting to weaken, that technology, which has been the market leader for the last decade, started to showcase signs of weakness, right? So, important thing here to keep in mind. But let's go ahead and take a look back at the two previous waves, back here in 1983 to 1990, as well as here in 2000, downward towards 2002. Both of these were multi-year periods where we saw an over 45 to 61% decline from the technology companies in the performance against the broader stock market. It doesn't mean that they went down that much or only went down that much. It just basically means that essentially, comparative to the S&P 500, these stocks heavily underperformed. More likely than not, it means that they were dramatically overvalued. And we see this within market structure here with these kind of blow-off tops and price with major corrections afterwards, closing out multiple years of gains that we saw previously. And this is a really big problem that I see with a lot of investors out there. We've been kind of told over the past couple of years that you can just buy the dip, and we know that the Federal Reserve is going to come to the rescue and prop up assets, or just something is going to make the market go up. The market always moves up, right? And while that is true in the long run, that generally assets are going to appreciate, it is important to understand here that it is not guaranteed to happen right away, and it can take multiple years, if not a decade, to get back from where you entered. If you had bought many of the equity plays back here during the dot-com bubble, even some of the safest plays that are now some of the largest tech companies, like Amazon and Apple, the important thing to understand is that you were likely in the red for a decade or more in your position. And that's a very important dynamic that a lot of people don't consider when buying the dip here. So make sure that you don't rush in to one of your plays before you understand whether or not you've really come down to a reasonable correction point. And this is, again, while we talk about on the channel here, while everyone has a right to disagree or see things different, we talk about sometime later into this year, into 2023, coming into the next year, where we're going to have a better correction range. And I'm not even calling for, say, 45% or 61%, but somewhere around 35 to 40%. Right, within this range where we can see that it would basically be a good range for price to potentially consolidate between. A lot of previous support in the past and previous resistance. Great technical point here, and it would be in line with previous corrections. I don't think we're going to have a decade-long correction here, but it's important to understand that there are periods of time where things go down. Another chart that can demonstrate this, and I think the next chart is even more beautiful. It's another exclusive chart that we shared with the Dash Report members, is taking a look here at the NASDAQ on the quarterly time frame. And the breakdown of what this chart tells us about generational innovative cycles and blow-off tops. Now, if we take a look back, a big step back here, I know this doesn't have so much to do with crypto, it may seem, but it has everything to do with it. If we understand essentially that innovation is what drives growth, and it's what drives boosts in productivity and the well-being of people, right? Of course, technology has its flaws, but we get here that we live in such a better time than we did decades ago with the advancements in technology. We understand that these come in waves. Back throughout the 1970s to the 1990s, a 20-year period, we saw the invention of mainframes, personal computers, the internet, enterprise software like ERP. We saw a lot of things that completely changed the way we do business. And those technologies, a lot of them did see adoption, but also some of them as well were in their infancy, mainly the internet and the personal computer. And these technologies, while they did bring a lot of value and revenue into the economy, they became overvalued. You can see a very clear, decisive trend line that price had followed all the way from 1974 here to 1995, and then something changed. We started to see a parabolic blow-off top here in price, where things got overvalued, overextended. If you bought technology plays during this period of time, whether it be the large plays or the small plays, and ideally, if we're using this analogy, cryptocurrencies, if they were around at the time, you could be left holding positions that not only drop down to 60, 70% and hold down on those lows for years to come, but many plays that never come back and go practically to zero. A lot of companies got wiped out here, and we'll talk about that a little bit later on as kind of the third talking point. But as we can see here, very similar structure. A nice solid trend upline here, upward trend line, and then we get what can only be seen as a smaller but still significant blow off top here, towards around 16,000 on the NASDAQ. And we're only back to the midpoint line. But if we look throughout history, we see that the secondary wave of these recessions, while I don't think it's going to be as severe as the dot-com bubble, I think we are still going to see a formed move below that line. We are going to see price come down there in a similar range we saw price back a couple years ago before the blow off top. That is a simple, typical market structure here. Now this time around, again, going back to the chart, we had the same exact thing happen last time. We have smartphones, e-commerce, social media, advancements in semiconductors and biotech that have completely transformed the way we think about living in today's world. Back a couple years ago, we didn't have this in our pocket, and it completely changed the way we live our lives, for the better or worse, right? We spent a lot of time and a lot of money on these devices, and because of that, it brought about a wave of companies that have continued to prosper. But if we got to be honest with ourselves, similar back here to the dot-com bubble, and this is what defines these market tops, companies have slowed down their pace of innovation. Not to mention, not only seeing much innovation right now comparative to what we've seen over the last decade, as a lot of technologies are flatlining, and we can see this through the revenue of many companies. But if you think about companies like Amazon or Google or Apple or all these major technology plays or Microsoft, they benefited immensely during the pandemic back in 2020. It was one of the best periods of time. It was the max period of adoption. I think of companies like Zoom, for example, that just did absolutely well when everyone was practically forced to be at home, but now everyone's returning back to work. People are maybe going out shopping more, to the store. That is going to put a dent in the growth potential of the companies that absolutely benefited over the last decade. And we're going to start to see declining numbers for a period of time. We've already started to see it in earnings. You guys can dive into it yourself. Now, what does that tell us here? It tells us that stocks have room to go down. Very, very likely they are going to be moving lower rather than up because of the fact that when we look back at history, if we turn off our drawings here, just simply look at the chart, we know that stocks move up on future growth potential. And right now, we are not seeing that. We are seeing earnings projections that are pointing to the next couple of years being a brutal window of time, for better or for worse, for stocks, especially those that are focused on growth. And when growth is slowing, that's when it's most painful to pick up positions in equities. That is not when you want to be buying the dip. We want to be buying the dip on minor corrections during growth periods. We want to not be so greedy about waiting for low prices during those optimistic period of times. But in these longer term fearful periods, you got to be a bit more cautious. Buying the dip is not always a guarantee, because while you might be buying the dip here or here or here, you might be holding a position for years to come and will likely panic sell after taking a further decline in your positions. Most people say they want a dollar cost average, they want to buy the dip. Many of them can't stomach the fact that they might be holding out for a long period of time. So that's point number one. Point number two is that in these periods of time, when you're considering to buy the dip, you need to understand and ask whether or not bullish indicators of support are serving as support once again, or worse off, as resistance. I want to go ahead and dive in. This is another really interesting chart here to dive into when we're talking about the equity markets, but it also plays into crypto as well. We'll dive into a chart about Bitcoin in a minute. This is one of the few kind of legacy indicators we have for the big tech plays. It's an aggregation between the performance of Microsoft and Amazon. And again, you can calculate this through TradingView through MSFT plus AMZN. And I think what's really cool about this is that we get to lay out two of our favorite technical indicators, the 200-day moving average and exponential moving average, as well as the 200-week moving average and 200-week exponential moving average. Now, what these moving averages do is they aggregate the performance of the last 200 candles on their respective time frames. So if we're, for example, looking at the blue line here, which I can kind of go ahead and pull out my indicators, we're seeing is around 400 to 418 on the daily. That basically means that was the average point here on this custom index we created, right? We can see that price is below it. And for the orange and red lines here, the 200-week moving average and 200-week exponential moving average, we can see that price is slightly above it here, right? So essentially, these are moving up as price is moving up over time, and they start to move down when price starts to move down, right? Now, the important thing here that I want to focus on, I want to zoom in here, right? Well, we've got some text dialogue I want to dive back into in a moment. We can see that throughout the bull market, as we just kind of scroll through, that 200-day moving average is a perfect entry point here into these tech plays during a secular bull market, during those risk-on periods where the growth is good and the companies are continuously expanding, they're breaking expectations, everyone is feeling the good times, right? But we can see very clearly that as we move higher here, there are not only slightly more breaks here on that 200-day moving average, possibly signaling that we're getting towards the later stages here of the cycles. We talked about, remember, those early signs in 2021, right, starting to showcase, right? We can see here that now that indicator is clearly serving as resistance. It has never done this throughout the last decade, more than the last decade, in equities price action, right? And we can see that 2 times we've already gotten resistance here, and now we're hanging by a thread on the next level of support, which is that 200-week moving average. Now, I'm not saying we can't get a tiny little bump up here over the next few days or weeks, but you need to wonder what happens if we don't hold that line. What happened last time when we couldn't hold those moving averages. Well, we don't have the price information here, but you can roughly see here that from this point on, where those moving averages were on here on the weekly average, we still had about halfway to go down here, from around 33 points on the index down to 20 points. A brutal correction. Or back here in 2008, when we broke that metric, we went from 30 down to an even worse price point, down at around 18 points on the index. To put that in relative terms here, with a relative target we've been looking for here, that would take us down from around 367 points down here to potentially somewhere around 200 to 250 points. And again, it's not a matter about picking the bottom. I'm not trying to get you guys to focus on waiting till the potential absolute lowest point it could go. It's about looking at the chart here and knowing how long you could be in the red, even if you buy the dip, right? There are opportunities where price could still, years out, go lower. Will you be able to stomach that? Will you be able to hold out? A lot of people say they will. A lot of people can't. And that's why, again, it's best to dollar cost average slowly and passively during these periods of time, because the bear markets can not only last longer, but it can also take a long period of time before you start to see that next growth phase. And I know a lot of you out there, you guys are patient. I know a lot of you guys are focused on the long term. If you're here on the channel, I know you're different than the broader audience, right? You're not here looking for the next 100x altcoin. Maybe you are. I think we all would love to. But the fact of the matter is, we're probably keeping things more rational, right? Now, I want to go ahead and talk about the kind of like key point here as well. And two of our partner tools here, you guys know we utilize Bookmap here on the channel. This is one of our tools to utilize market order flow. This is a great example here of, again, getting some further insights into what the market is telling us. While price has been relatively neutral for the last 7 days, we can see that market order flow here has been abysmally negative. Over 10,000 points on the cumulative volume delta. This showcases here that still, even though price is remaining neutral, the vast majority of the market who's feeling more emotional and getting out of their positions, they're selling. They've been continuously selling, and they're not done yet. While there are some people who are providing bid support and buying up here at these levels, at the same time, the market order flow is still immensely negative. And until this starts to switch, until that trend starts to flip, until we start to see those indicators breached, right? Real capitulation, where we eventually start to use them as support once again, right? Those bullish indicators, and I'll use an example here with Bitcoin, right? We've got the 200-week moving average, which used to be the ultimate buying opportunity, now serving as resistance. Until we can get above that 200-day moving average or that 200-week moving average, start using those as support once again, we are likely going to continue to decline here over the next weeks, months, and potentially for a year or more. I know that that's painful to say, but it's the reality we need to face. And we can see this again in our other partner tool here, CryptoQuant, right? We've got the, for example, the net unrealized profit or loss, one of our favorite indicators here. We can see that over time, we usually have these higher lows here, but we've not only broken that rule this time with the correction back in June, but as again, we start to see price hanging below here, we should expect here that the previous bullish indicators where we buy in are likely not going to hold out like they did in the past. Data science is great here, but I think it's our perspective of how we look at data science. We should see that in the past, we've gotten much worse corrections here, and we should expect that we are likely going to see something like that if our moving averages are not acting as support and the traditional things that we relied on are not holding out, right? So that's point number 2. But I want to go ahead and talk about point number 3, which is probably one of the biggest takeaways, guys, because if you're buying the dip on Apple, if you're buying the dip on Bitcoin, you're probably going to do well no matter what, especially if you have that discipline to hold out in the long term. But what I want to go ahead and talk about is a very important reality that all those YouTubers, all those Twitter personalities out there who are telling you the next altcoin gem, the next tech stock you got to buy, all these things, or God knows how many people out there are telling you to buy an NFT drop or the next big NFT that's going to be the next Bored Ape Yacht Club or whatever. The important thing you got to understand is that especially if you're investing in technology and innovation and growth, you got to know that the vast majority of investment opportunities are going to go down to zero and never come back. I want to make this very clear here, guys. I'm always going to be honest with you all. It's why we don't promote leverage trading here on the channel. It's why we don't have videos titled the next 100x altcoin gem. right? Even though that might do well for views, I don't care about that. I'd much rather be honest with you all because I believe that wins out in the long run and it's the right thing to do. The vast majority of plays, whether it's here today or back in technology phases like, or those innovation waves like the dot-com bubble and then INDs to the early 2000s, the vast majority of plays go under, okay? So I'll go ahead and just showcase this here through a couple of charts. First off, let's go ahead and take a look at the dot-com bubble here, right? The dot-com bubble was made up of a whole wave of really interesting and exciting companies, but it was also filled with a lot of companies that were heavily overvalued, were heavily overvalued on the hopes of what the internet was going to become in a matter of a year or two, and that the revenues, even though they were abysmal at the time, they were going to catch up, right? The internet was here to stay. And while they were true in the long term, while the investors were right, they were just way ahead of their time by about 10, 15 years. At the same time, it's important to understand that 95%, over 95% to 98% of the technology IPOs that launched in the decade leading up to the top of the dot-com bubble collapsed. And they never came back. They delisted, they filed for bankruptcy, they got acquired for pennies on the dollar, leaving shareholders in abysmal investment positions. And you can see as we scroll through the list here, we have Alta Vista. This was one of the biggest web search engines, right? But lost ground to Google and was purchased by Yahoo in 2003 for pennies on the dollar. 360 Networks. We have huge amounts of companies here, some of them like pets.com that might be more familiar to you. But you really scroll through here, even companies like 360 Networks that were an over $13 billion company filing for bankruptcy just a few months later. Some of even the strongest names completely faltered during that period of time. Now, I'm not trying to be negative here. Technology goes through these waves of filtering and aggregation and conglomeration to finally have companies that have the weight and the capital reserves and the incentive to actually go out and build technology that's lasting and profitable. But, I mean, as I scroll through this list here on Wikipedia, guys, I can tell you all, the list is even bigger than this. But this is just a great example of the companies that were either hit immensely by the dot-com bubble or very likely shut down and filed for bankruptcy, leaving investors with nothing. Now, if you've already been through some losses here, folks, throughout this bear market, don't make it worse. Make sure you know that you're buying a well-diversified portfolio of crypto and equities, and make sure that it's in names that can weather the storm. This is not the time to be betting on startups that are burning through capital in an environment where it's so costly to borrow due to the federal funds rate being so high and the central bank, the Federal Reserve, lowering its balance sheet. That means there's less money for venture capital. There's less money for those kind of tech names out there. It's a very, very important thing to do when you're making your investments and potentially buying the dip. And last but not least here, I wanted to take a look at what we've got going on in the crypto market. This is a snapshot, a really cool tool from CoinMarketCap. You guys can click on this section here under cryptocurrencies, historical snapshots. This is a snapshot of just a little over 5 years ago, back in January 2017, right around when I was really starting on my personal journey in crypto in 2016, 2017. And take a look here at the list of the leading cryptocurrencies. Some of the most reputable names here. It plays like Dash, Ethereum Classic, Monero, Augur, MadeSafeCoin, Steem, Neem, Iconic, Factom, Dogecoin, which you guys probably remember, Waves, DigixDAO, Stellar, Zcash. Many of these names you might remember or maybe even know, maybe even hold some of them or have held them at one point. But if I can tell you one thing, guys, it's that they've heavily underperformed against Bitcoin and Ethereum in a few of the plays that held out in the long run. Many of them fell behind and are no longer in the top 100. That's just the cold reality of it. And there's no, there's no punishment for, again, people who say, oh, this is going to be guaranteed to win in the long run, right? As a content creator, myself and others, we're just doing our best here. But my job here is to be as honest with you in looking back at history and showcasing that a lot of even the leaders today won't be up in this list. And ironically enough, you would have been just better off holding Bitcoin and Ethereum or trading these plays in the long run. So That's a key point to keep in mind here, guys. But a lot of what we talked about here today are things that we chat not only here on the channel about to some degree, but also in our newsletter here on the DataDash channel. This is what's known as the Dash Report. Now, there's a link down below in the description if you guys want to check it out. But it's our newsletter where we cover every single month. We put out a newsletter where we talk about crypto, equities, Forex markets, commodities. We cover a whole macro perspective. And on top of that, it's not just a newsletter. You guys will get access to our trade alerts. We send them out over Telegram, our Dash Report discussion group where you can talk to hundreds of other members from the Dash Report community, some of our most active members and most creative members. And on top of that, you guys will get access to exclusive market updates, mid-month webinars, all kinds of stuff that we send out to our Dash Report members. It's all aimed at trying to provide these unique perspectives and multitudes of data points so we know what's best to do in the market, right? And while we don't always get things right, we've been able to take advantage of the recent summer relief rally back in August. We sold a lot of positions, went into cash, and now we're starting to look for the signs of when it's time to get back into the market. So if you guys are interested in that, if you guys understand the value of knowing when to properly time those entries and waiting for the trend to reverse and give you the right sense to invest, then you might find the Dash Report valuable. And you can get 20% off if you sign on for an annualized basis. So we'd love to have you as a part of that. But even if you guys can't do that, it's no worries. If you can just drop a like on the video, it's one of the best ways you can support the channel. But until the next time, everyone, I'll see you all later. Have a wonderful rest of your day. Trade and invest smart, and I'll see you all in the next video. Take care, everyone.